related to inventory valuation and how the accounting standard 2, the Indian accounting standard 2, that is the IND AS-2, as well as the IFRS variant of international accounting standard 2 deal with this problem. So first up, I'm going to talk about some of the background of cost accounting, where this problem arises in the first place, and how the accounting standards, that is the actual accounting, really deals with it in the financial statements. All right, so we would walk through this scenario, that is the ideal is equals to actual capacity. So in this case, we have the normal production capacity, which is defined as your long-term average production capacity adjusted for your planned maintenance and your expected breakdowns. So what would be your average production over 5 years in a year? That would be your normal production capacity somewhat. So the variable cost is estimated at 6 per unit. The actual production is 1,000 units, that is equal to the ideal, that is normal production, and the fixed costs are 4,000 per period. So we have assumed that the fixed cost is 4,000 per unit per period. Other expenses are 300. We have selling price per unit of 14. However, unfortunately, we have not sold anything because this is the first year of production. Therefore, there is no opening inventory also. So in absorption costing, what would happen? We would have no sales because we have not sold anything yet. The variable cost would be same as the production times the variable cost per unit. The fixed cost, what we do is we use a FOAR, what we call is FOAR, the FOAR, which is the fixed overhead absorption rate, which is defined as 4,000, that is your expected fixed cost, divided by your expected production, that is your normal capacity, that would be your FOAR. You would be absorbing a fixed cost based on this. So that would come around 4,000 again, because ideal is equals to actual. We will have no over absorption or under absorption. The inventory, closing inventory, is valued at variable cost plus fixed cost per units. So the inventory is valued at 10,000. All right, and therefore we make real losses of 300 because we have some other expenses of 300. All right, so this is an ideal scenario. This is how things should look like, but things start to change in cost accounting when we see a scenario which is, first, the ideal production is less than the actual, or the actual is more than the ideal, no matter how you say it. Okay, so the FOAR would remain the same, that is 4 per unit. Okay, so the FOAR would remain the same. I'll just copy and paste. Oh, sorry, paste. Okay, so the FOAR would remain the same. However, what we will be seeing is we are making profits out of thin air. Let us walk through this one. Okay, so the same sales is same, variable cost again 1200 times 6, that is okay. All right, fixed cost, okay, 1200 times 4, so that is 4800. We have absorbed more than the fixed cost, so we will be adjusting for over absorption. Therefore we add back the 800. However, you may see there is a financial shenanigan in the closing inventory. So the closing inventory is inflated. We see that the closing inventory is inflated by how much? By more than, I think, 800 less, that is 800. By inflating the inventory by 800 and adjusting it again in the bottom line as an income, we have made profits out of thin air, that is 500. Okay, so we made thin air profits. So we conclude that if you are efficient, yes, we were efficient because we made more than the production. We made more in production than normal capacity. But the benefit of this is you get thin air profits in cost accounting. All right, so this is our conclusion one. If you make more than what is your ideal, or your ideal is set too low, you would be making thin air profits in cost accounting. Okay, so we move to the second scenario, that is your ideal is less than your ideal is more than your actual production. So if you set your ideal production capacity way higher than your actual production, here in this case 800 is your actual production and your ideal production capacity is 1000 units. So what you would be getting is an actual loss of 1100 because you're absorbing on the FOAR. We have under absorbed the fixed overhead, therefore we are getting 800 as a bottom line loss from FOAR, and a 300 other cost has also incurred, so therefore we get 1100 of net losses. So in case we are making less than production capacity, we will be more inefficient. We are making less than the production capacity, the consequence of which is you make real losses. And we can conclude that your abnormal losses, which is your inefficiency, which I think is an abnormal loss, is not your asset. You cannot capitalize on it. So what could happen in this case? In the first scenario, that is when you are efficient, you may want to use FOAR for absorbing so that you get thin air profits. But in case where you are inefficient, you may want to use the FOAR based on actual production. Therefore, what we would do is 4,000, that is our fixed overhead, divided by 800. That would give us the same net profits as the ideal capacity, but we have inflated the inventory and capitalized our abnormal losses. Because how can you capitalize on your abnormal inefficiencies? Do your inefficiencies become your asset? I don't think so. And that is why the FOAR exists. So FOAR would highlight your inefficiencies, but it would also reward you for your efficiencies. So how the accounting standard 2 really deals with this problem, where inefficiency and efficiency both are not capitalized. So the accounting standard 2, this is an extract of Indian accounting standard 2, the paragraph 13. The allocation of fixed production overhead to the cost of conversion should be based on normal capacity of production facilities. The normal capacity is the production expected to be achieved on an average over a number of periods or seasons under normal circumstances, taking into account the loss of capacity resulting from the plant maintenance. I think this is self-explanatory, how normal capacity is a long-term average adjusted for plant maintenance as well as your expected breakdowns. The actual level of production may be used if it approximates the normal capacity. If your normal production is close to your actual production, you may use the actual production. The amount of fixed overhead allocated to each unit of the production is not increased as a consequence of low production or idle plant. Therefore, we see in the example 2, when I change this to 4,000 divided by 800, that is absorbing on our lower production, that is our inefficiency, idle production, lower than usual, we would not capitalize on our abnormal losses. That is what the accounting standard is saying here. Therefore, we would not be doing the same thing. I would say this is again the same thing. All right. And then we have what it says next is, in periods of abnormally high production, an amount of high fixed overhead allocated to each unit of production is decreased so that the inventory is not measured above the cost. So that is what was happening in the scenario number 2. That is when we valued the inventory more than its cost. We just spent 11,200. We capitalized 12,000 in the books of accounts, therefore inflating the inventory cost. So the accounting standard really emphasizes that both the things should not happen, neither capitalizing your abnormal losses, neither capitalizing on your efficiencies. All right, so let us see the scenario of our accounting standard. That is the scenario for all three circumstances. So the key determinant in this case is based on prudence. I would see prudence basis. All right, so fixed overhead budgeted, that is 4,000. All right, based on actual units, we would get 5 per unit, and based on normal production, we would get 4 per unit. As for prudence, what we would be doing is using the lower rate to absorb fixed overhead, therefore creating under absorption or never create an over absorption. Therefore, we will never have an over absorption. We'll always have under absorption. All right, so we'll always be deducting for inefficiencies, but never capitalizing our efficiency in this manner. So let us try this one. And if I change this to 1,000, we would be getting 300, and we should never be capitalizing on our efficiencies. Therefore, if we make 1,500 units, we would be making, oh my god, I have not done this really well, I guess. Oh sorry, I changed the fixed cost. If I make 1,500 units, I should never be capitalizing on it. If I make 1,200, I should never be capitalizing. If I make a 10,000 units, I will never be capitalizing on my efficiencies. But if I make 100 units instead of 1,000, I would be losing much more. So you will be punished for a inefficient production compared to your normal capacity, and an efficient production to your normal capacity would not result in thin air profits. Therefore, it is essential that the ideal capacity, that is the normal production, this is a key metric in this shenanigan. If you set the normal production capacity way lower, you would never make superficial losses, at least as per the accounting standards. But if you have uh, the normal capacity way higher, you may make losses. That is the problem. I think the accounting standard 2 deals really well with this, and this walkthrough really helps you to understand how you can never capitalize on your efficiencies, but you can always lose out on your inefficiencies as per the accounting standard 2. And I think the standard on auditing 501 never states anything about the valuation assertion, and you can find my rant on SA 501, that is audit evidence relating to specific items including inventories. And in the previous video I have talked about the SA 501 and an overview of 501 as well. I think the standards on auditing should really talk about valuation point of view sometimes, because the accounting standards do not give emphasis enough on the normal production capacity, whether it is close to normal or not. How do we really manage this metric? This metric is the key to a financial shenanigan. If I set this to about 200, I would never be making losses. If I am making 100 units, then only. If I'm making 1,000, then no. But if it's 10,000, if it is overstated, I would be making losses every time. So this is a key shenanigan. This is an accounting estimate. I think SA 540 deals with accounting estimates, and this is an accounting estimate. But I think some reference of this accounting estimate should have been made in relation to 501. I think that's fairly old standard now. I think it needs a bit of revision. It talks about audit evidence, and 540 is again an audit evidence standard relating to accounting estimate. This is an accounting estimate, let's be honest. But I think the valuation assertion is not really talked about much in relation to inventory, whereas I think the inventory valuation is a key point to alter financial statements and create more financial shenanigans. And I think I hope you like this video, and catch me up the next time.